Hey everyone, welcome to the KE Report, a special Sunday daily editorial. We are chatting with Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark to Market website. Mark, as we usually do with you, we'll talk currencies. We're also going to talk big picture in terms of, I guess, capital flows. Money, clearly, it seems like flowing out of the US as markets, they've been volatile, a little bit of a rebound at the tail end of the week after a really bad start to last week. But the one thing that really stood out to me just this last week was the US dollar continuing its downward move. Remember, we entered this year, it was in the first 2 weeks of this year that the dollar touched 110 on the dollar index. And on Friday, it moved below 100 on the dollar index. That is a crazy move for a currency, especially the US dollar. We're also seeing some interesting moves in the bond market where instead of money going into US bonds that you would expect during a market sell off and volatility, actually bonds have sold off. Yields rebounded at the tail end of the week and throughout the week. So again, there isn't money going into the typical US safe havens that one would expect during this volatility. Mark, what stands out to you in terms of either currencies or bond market moves?
Yeah, I say that what they have in common is two things. One is volatility. We've seen a big jump in volatility, and that's because of the second thing. People have uncertainty. There's just a great deal of uncertainty about the direction and the meaning of U.S. policy, how central banks are going to respond. And, part of it is also that we think that we're proud of ourselves in the markets about the transparency and things like that, but the capital flows are anything but transparent. And so I think this great uncertainty helps create this volatility that people just are sort of like shell shocked, if I'd say.
Well, inside of that shell shock and that volatility, again, people would normally have gone to the dollar, they would normally have gone to bonds. There's some theories that you see floating around in financial media that this is international buyers pulling out of US assets across the board, equities, currency, and the bond market. There's, of course, people blaming China and saying this is China's retaliation for the tariffs and they're selling US treasuries. But you had a more nuanced answer when you were talking to us about maybe some of the arbitrages unwinding in the cash versus the futures on the bonds. So I'd love you to get you to break that down to offer an alternative viewpoint.
Yeah, so I think that this sort of political climate in the United States now is such that if something bad happens, if workers don't get paid as much as they think they should, if almost anything that goes wrong with the United States right now, it's sort of like a knee-jerk reaction to blame foreigners. So when we see the stock market selling off, we see the bond market selling off, we see the dollar selling off, and people just conclude it's got to be foreigners. And my real caveat here is that capital flows, portfolio flows are not reported in real time. We'll get next week the U.S. tick data. That's the Treasury's portfolio flow report. It comes out every month around the middle of the month. That is such a lag. It covers the month of February. The most real-time report that we get that gives us any inkling into capital flows is from the Federal Reserve. They act as the custodian for foreign central banks and official accounts. It's reported every week on Thursday afternoon for the previous week through Wednesday. And the most recent period, we saw that is the report came out on April 10th, and it was up to the 9th, and it showed foreign central banks were net buyers. Their assets at the Federal Reserve's custody account grew by almost $1 billion. Doesn't sound like a lot, and it's not in the big scheme of things. But I'd say that sign, positive or negative, is important here. And also, the central banks and official accounts have a bit more in them than they did, say, at the end of January. So I sort of think to myself, what's going on? It's possible that this sort of the story that I think we might have talked about last week, where Europeans bought a record amount of U.S. equities last year, about 108 or 110 billion dollars worth, and so they sort of bought, call it the Mag 7 when they were relatively high, and just seems to me that prudent money management would have forced them to sell in any event. But I think that's generally true that while there might be some foreign influence, that what's happening to the bond market, I think, is really telling. And a lot of people say that they know that the Japanese are selling, or the Europeans are selling, or Chinese are selling. It all could be true, but there's no evidence for it. And so I think that what people do is they look at, say, falling bond prices, rising gold price, and say, you see, foreigners selling U.S. stocks or U.S. bonds and buying gold. It all could be true. There's just no evidence for it. But I think there is some evidence for this other thing that's much more domestic and U.S. hedge fund based uh, activity, and that is what's called the basis trade. And rather than get into all the complications of it, let me just say that it's highly leveraged and it's large pools of capital because you're playing for very small increments. And what you're playing for, the basis, is the spread, the differential between the US, say, 10-year bond and the futures. And it's such a small, it's such a small incremental game that you're playing for that's leveraged. And some reports suggest it's leveraged by these hedge funds as much as 50 to 1. So at the first sign of pain, they have to unwind it. And it gets very messy when they unwind it. We know of past experiences, whether it was 2019, 2020 and COVID, the great financial crisis. When these basis trades get unwound, it's dramatic, it is violent, and it produces these kind of sort of like, I want to say like non-linear reactions in the market. It's hard to know where we are in the unwinding of the basis trade. There were estimates that it could have been worth as much as 500 to 800 billion dollars. So I think that a lot of times I think that our problems, including the market, are not so much blaming on foreigners, but it's self-inflicted. And it could be very much Americans. And you can see this too. Look at the currency futures. You have to declare in the futures market whether you are commercial, you have an underlying business, or you don't. You're non-commercial. Non-commercial is a nice word for speculators. And those speculators flows are important because that's discretionary. The people who are hedging, the businesses that are hedging, they're sort of hedging for the reason, and they're sort of like, they don't have much of a choice. But the speculators have a choice on taking on this risk. And speculators have built up a substantial short US dollar position. And so this isn't a question of speculators covering shorts and going long. This is a serious development that I think can be explained primarily. Again, I'm looking at the catalyst. Of course, foreign investors had to use money management practices and had to liquidate with proper this sort of money management discipline. But the catalyst seems like it's coming from the U.S. It's not simply the policy of the tariffs. It's the uncertainty surrounding it. It is the economic consequences. And those aren't the only issues, of course. There's a lot of other issues, including a larger budget deficit. I know people are talking about how Musk, one of the richest men in the world, is telling Americans what programs they don't need anymore. And yet we don't really see that showing up in the government budget balances. The budget deficit this year is, I think, through in the month of March, which just came out this week, the March budget deficit was about $15 billion higher than the previous month. Higher than the previous March. And so people are concerned about the budget deficit, the supply that's coming in. And I think that all these factors just add to this great degree of uncertainty and facilitating this like neck-breaking volatility.
Oh boy, it is neck-breaking volatility, but it's also, well, driven so much politically as well. Mark, you mentioned margin there as well. How much of these moves, the volatility obviously contributes to it, but also the downward momentum that we saw, is this at all an unwind of some of the margin that we've read has been at pretty extreme levels in the markets?
Well, I think that it seems to me pretty clear that there have been large margin calls. And so what do people use for margin? I think that helps explain why you see these sort of counterintuitive moves in the market. For example, when stock market was getting hit last week, gold got hit. This week, gold has rallied. Gold, what a great rally, right? 7% this week. I'm sorry, gold 6% this week. Silver almost 8.5% this week. And so once again, they get this the safe haven, but it's only after the margin calls were made. And so I think that sort of margin to me is a forced liquidation of other positions. So you take a loss on one position, your broker calls you, says you got to get out of it or give me more money, and you either get out of it, forcing it, still moving against you, or you liquidate something else that you have for margin. And that could be anything. That could be treasuries, that could be T-bills, that could be gold, silver, any kind of like safe asset. And in the currency markets, I'd say the way we see this would be that people talk about the Swiss franc and Japanese yen as safe havens. I think when we really unpack that, I think that what happens is that the yen and the Swiss franc are often used as funding currencies to buy some other asset, U.S. stocks, U.S. treasuries, emerging market bonds. And when those assets that they bought go south, which invariably they do sooner or later, you liquidate that asset and you have to buy back that funding currency. So as the U.S. Treasuries get hit, you have to buy back the Swiss franc. You long the Treasuries. Now you have to sell them because it's going against you, and you have to buy back the currency you use for funding. And it's kind of complicated, I think, for a lot of retail investors. I mean, I know when I buy something, I want that asset to go up. But what these large pools of capital do is they don't buy it with their own money. It's OPM, other people's money. And by that, I mean in the currencies, they're borrowing Swiss francs, borrowing yen, and buying these other assets. And so when these other assets go down, they buy back the funding currency, and thereby, voila, the safe haven characteristic. So I think that's played a big role. In the Swiss franc this week alone is up 5.4%. When you think about it, I mean, like I say, it's almost up as much as gold is. And the Swiss have interest rates, their overnight target rate, 25 basis points. And there's many people like me that think they're going to cut to zero, if not in June, maybe before.
Yeah, Mark, I think it's such a great point you're making that a lot of times the carry trades using the Japanese yen or using the Swiss franc, when you sell the assets that you bought with those other currencies, you have to convert back into them. So they give the appearance of being a safe haven, but really it's just capital flows fleeing other things they bought with those currencies. I want to bring gold into the discussion a little bit further with the currencies. You brought it up there and said, it's done well. But a lot of people mentioned that last week when they got hit for a while, that it was being sold because it was the only thing in the green. And so people were selling gold to cover margin calls. This week we did see a nice rally in gold. But if you look at gold versus almost any other fiat currency, it's up at all-time highs. So you have to acknowledge that gold has done its job as a safe haven globally and on almost any currency. But at this point, when you look at it, do you think it's a little overcooked? Could it keep running? Do you think we'll see that unwind as people sell gold to then maybe buy the dip in other assets? How are you looking at gold in relation to currencies and equities?
Yeah, huh? So we're finishing up the 15th week of the year, and gold is up 13 of those weeks. It's quite a streak. And so, of course, technical analysis would say, okay, it's extreme, it's overbought. But there's I want to say that if you think that these are normal times, I'd say, yeah, gold's overbought. In fact, it's trading, it's going to close this week above its upper Bollinger Band. And that Bollinger Band, two standard deviations above the 20-day moving average, measure of volatility, really, right? And that upper Bollinger Band comes in at around 31.95, and gold is trading, call it near 32.35. So it's going to be on a weekly basis, closing above its Bollinger Band, which would be a sign of its overbought condition. But I think that there's something more profound going on. And I think this is where a key tension in the market is right now, and it could be reflected in the currencies, which I think Corey was saying about how big the dollar index sold off this week. And I think that what's happening is that many people think or suspect that the U.S. might be losing its role in the world economy. That what Trump partly represents is pulling back from the U.S. empire. Some people talk about it as being isolationist. I kind of think it's more unilateralist. Freed, then that Liberation Day liberates us from international commitment. But I think that if you're in that camp that think that the dollar's role in the world economy is changing, and again, I say this because throughout my career, and even before my career began, people have been talking about this, the loss of the dollar's role in the world economy. In fact, sometimes in my presentations, I'll show people a Business Week article from 1978 that talks about the dollar losing its reserve currency status. So it's an old story, but now with President Trump in the White House, it gives it new energy. And if you think that there's something going on like this, then gold is not only for central bankers, but it's also for individuals in a way that maybe is more compelling, which it might help explain why we've just shot up here the past 3 days from below 3,000 to above 3230. So I'm careful. I mean, I own some gold, gold ETFs, and I'm happy with them. But I've got stops in the market to protect myself because I just regard it as just being fortunate and wanting the money management. Because I think that's really the key. 'Cause I imagine you talk to a lot of people and you hear from a lot of different ideas about buying this and selling that. I get it. I mean, it's part of my job too. But what ultimately distinguishes successful, profitable traders and investors from those who aren't as much is really risk management. Everybody knows what to do in an up market. Like pat yourself on the back, you're right. But it's really when things go against you that's really the key. And I've worked with a lot of professionals over my career, and even on the professional side, it looks something like this: make a little money, make a little money, make a little money, lose a lot of money. And those drawdowns is really reducing those drawdowns becomes really the key to being successful. And reducing the drawdowns means disciplined risk management. And so for me, yeah, gold's at a good ride. We're closing at record highs. I suspect that we could go up to 3,500 or something like that. But money management is the key.
So, Mike, I get your pushback on that whole narrative of the dollar losing its kind of reserve currency status because we have heard those stories for decades, even more than just a couple decades. But does this time feel a little bit different to you? I know it's still potentially very early on, or if this is the road it's going down, then it is extremely early on. But there is this shift both in the US and then globally of a way out of the US, not looking at the US as the rule of law, the beacon of hope that it so often has been over history, which has led to markets getting simply a higher multiple than any other market. Is it possible, though, that maybe it doesn't lose its reserve currency status, but the markets globally just get viewed differently and the market, in a sense, loses its global dominance?
I think that something like this is happening that maybe kind of like squares the circle for us. And that is that what happens to people need incentives to invest. And the US often offers an interest rate premium over Japan and say Europe. And that means partly you're paid to be long US dollars. And I think what's happening now, partly because of the sort of about face by the Trump administration reversing traditional US policy, that investors, domestic as well as foreign investors, want a higher interest rate premium for staying long the dollar. I don't see this as central banks. You know, growing up, we were always, I remember in grade school having to like hide underneath our desks during these air raid drills as if Russia was about to attack us. And the reason part of this kept the Americans agitated and willing to fund defense spending. And so now I think that this current generation, now China is the boogeyman. And things that go wrong, blame China. So I know people are saying that China is selling bonds. And I'm not convinced. I mean, they could be. I mean, I don't know what China is doing with bonds, but I really want to say that I doubt that anybody else does. And people who make these claims, I want to say, where is the evidence? China doesn't report what they're doing. And the US Treasury portfolio flow data comes with a big lag time, and China's learned different ways to hide what they're doing. And so my suggestion really is that if China is really annoyed with the US, is at having this like low level economic war. But before I finish that thought, let me just quickly say that this past week, very important story, not being covered much, and that is that in East Ukraine, they found several Chinese fighters. And Ukraine says that they've got two Chinese POWs. Ukraine's turning into this little bit of this world war, it looks like. But what I was going to say about what China's going to do, I think, is selling treasuries is a bit self-defeating. Where are they going to put their money? If they put their money in almost any other bond market in the world, they're going to get a lower interest rate. They're going to give up liquidity and they're going to give up transparency and arguably security. I think that is not China's way. I think that here's what I suggest to you as an alternative to China's way. They are not only a huge producer of rare earths and these critical minerals, but they also have I want to say like 80%, 90% of the processing of it. Because you can get these rare earths, they're not so rare, but it's very expensive to process them. And China has been doing this for a while. They've got the technology, they've got the capacity. And what they announced this week is they put export restrictions, export licensing on several key these critical earths that the U.S. needs. I'll give you an example. An easy one is like tungsten. You need that to make semiconductors, for example. Or you need some tritium, which is used to make jet engines, both fighter jet engines and commercial jet plane engines. And so, of course, U.S. companies have some inventory, but they're going to wear down that inventory. And China, and I say this, that President Xi, who's now president for life, is going to most likely going to outlive Trump. He's going to be in power longer than Trump. And this is how China takes its revenge on the US, how it fights back without shooting itself in the foot by selling a little bit of its treasuries and making the rest of its inventory lose value. So I think that if we try to think of this as, what did Chad call it, a 4D or 5D chess? We think of it along those lines. I think that this is what they're going to do. It's not going to be selling treasuries. After all, the Federal Reserve has shown in the past willingness to buy treasuries. They can absorb them. That's not the answer. The answer, the more critical answer from China's point of view, would be to cut off or limit these rare earths to the U.S. like they did to Japan several years ago.
Yeah, Mark, I think we've seen a lot of that just over the last year is export bans on certain minerals, and we've seen everything from germanium and antimony to tungsten, which is also important in steel. You've seen it with the rare earths a number of times. We saw it back in 2010 to 2012 when China did the same thing, and it was a very effective strategy for them. And that's also why the Trump administration has been coming out with executive orders to try to get domestic critical minerals development going to try to counteract that. But that's a long road to haul. There's a lot for investors to think about with the tariffs, with volatility in the markets, what's going on in the bond market, what's going on in the equity markets, what's going on in the commodities markets. We haven't even talked about oil crashing down sub 60 earlier this week, and a lot of moving parts. But I want to kind of get your thoughts on looking ahead. Does economic data matter that's coming over the next couple of weeks? And if so, what economic data do you think is going to move the needle?
Yeah, and I think you're right, Chad. I don't think that the economic data is so important, partly because it's too old. And by that, it could be February data, it could be March data, but still too old, given these tariffs, which are still going to take a little bit of time to filter through the system. I mean, look, Musk, the richest man in the world, is telling us what social programs we don't need. And yet, the budget deficit has gotten bigger. And the jobs data, including the weekly non-farm payroll data and the programs that federal government workers use to collect unemployment benefits, not showing much of a sign of these large government layoffs. I suspect that they're coming. I think many people like myself expect that they're going to be coming. And for very nuanced, idiosyncratic reasons, they haven't shown up yet. But we suspect that it will, maybe towards the end of this quarter. And I think that that's really to answer your question specifically, I think that a lot of this data doesn't matter so much because it's too old, doesn't take into account the latest developments, the tariffs, the market chaos. But we see this in some close to real time things like University of Michigan consumer confidence. They just came out today with the with the preliminary April data, and it was not only did it show a huge inflation expectations jump, especially for the short for the 1 year, but when you look at the confidence numbers, what's happening in the U.S. has really been a blow to American investor and household confidence, insecurity about jobs, insecurity about what's happening. Sentiment was at 57 at the end of March, and it fell to almost 50, about a little bit below 51. Expectations collapsed from 52.6 to 47.2. These are just like horribly low numbers and often associated with recession.
And that's what everyone's talking about now, too. Recession, even depression has crept into the narrative. Fact of the matter is, we are still very much trading and living off of tweets right now. Economic data, as you said, is kind of past news. And I think a lot of people are just expecting for that data to get worse and worse. So even surprises to the upside seem to be tempered with the fact that something else could just come out of Trump's tweeting account and change the whole market direction. But right now, I think it's pretty obvious. We are seeing investors nervous and a lot of investors, I think, simply turning away from US markets. We'll see how that all plays out. Sometimes this can be great buying opportunities, but it can also be the toughest time to buy. And right now, there's still just so much uncertainty out there. Marc, thanks for taking time with us on this Sunday. Again, Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark to Market website. Click that link in the show notes to follow along with Marc's writing on a daily basis. Marc, have a great rest of your weekend, man. Thank you.
Thank you. Good luck to everybody.